In a recent Facebook post, Dave Ramsey claims that cash value life insurance is the payday lender of the middle class. Don't fall for it, he continues. Term life insurance is the only way to go. So why did Dave Ramsey compare cash value life insurance to payday loans? Because payday loans are the one thing that literally everyone hates. So it's the perfect way to get your attention. Payday loan companies are widely viewed as preying upon people who have fallen on hard times. They target the financially unsavvy who struggle to make ends meet. If there's a sucker out there, payday loan companies are sure to track them down and drain their bank account. So let's get a sense for exactly how bad payday loans are portrayed in the popular press so that we can appreciate the full weight of Dave Ramsey's accusation. Here's what the Huffington Post had to say about them. If you calculate the loan's APR, or what that loan would cost over the course of a year, the true interest rate balloons to a level far beyond that of most credit cards and bank loans, a whopping 260%. Doing the math is essential to avoid ruinous setups offered by lenders such as Western Sky, which offers a $5,075 loan that can lead to an appalling $40,872 in repayment. In short, payday loans are for people who don't read the fine print. I mean, 260% interest, who'd ever knowingly sign up for something like that? The unsuspecting soul falls upon hard times, turns to payday loans out of desperation, and then gets sucked into a debt cycle that literally breeds them dry. Pretty scandalous stuff, right? Well, I'm certainly not here to defend the practices of payday loan companies. But is this the type of experience that people have when they buy a cash value life insurance policy? Are the owners of cash value life insurance policies really getting sucked into a never-ending cycle of debt, interest, and financial ruin? Is this an apt analogy? Or is all this more Dave Ramsey hyperbole designed to get you to buy term insurance from his term insurance purveyor of choice, for which he almost certainly receives remuneration? Now, cash value life insurance isn't for everyone. It has to fit your particular financial situation. But take a listen to this excerpt from a recent video I did where I explain exactly how cash value life insurance policies, or what I refer to as the L.I.R.P, really work. As I do, ask yourself if Dave Ramsey's analogy is on target, or if he's just trying to scandalize you into buying a term life insurance policy from which he will invariably profit. For starters, what is an L.I.R.P? Well, it's a bucket of money that gets treated differently for tax purposes than any of your more traditional investments. What happens is that you put money in, and as your money grows, your bucket begins to fill. Only the IRS says that the growth on the money in that bucket is going to be treated under a different section of the IRS tax code than any of the traditional government-sponsored retirement plans. What does that section of the IRS tax code say? It says that you can touch this money pre-59.5 without penalty. Can you do that in your 401k or your IRA? No, you can't. It's also going to say that as your money grows, you get no 1099s. What does that mean? That means no tax as your money grows. They're going to tell you that when you take the money out, if you take it out the right way, that it doesn't show up as reportable income on your tax return. What does that mean? That means that it's tax-free and does not count as provisional income. It does not count against the thresholds that cause Social Security taxation. They're also going to tell you that there are no contribution limits. Here's an example. What are the contribution limits for the Roth IRA? For married couples over age 50, it's $7,000 each for a total of $14,000 per year. Folks, I got clients that put $50 a month into this bucket, and I have clients that put $200,000 per year, and everywhere in between. There are no limits on how much you can contribute to this bucket. They're also going to tell you that there are no income limitations. Let me ask you a question. Can Bill Gates do a Roth IRA? No, he can't. How come? He makes too much money. You start making more than $214,000 of modified adjusted gross income per year, you can no longer do a Roth IRA. Can my children, the youngest of whom is 7, do a Roth IRA? No, in order to do a Roth IRA, you have to have earned income. My kids work, I just don't pay them. None of these rules apply to this particular bucket. This last one's probably my favorite. It's this: if history serves as a model, there may be no legislative risk. What does that mean? Well, let me give you an example. They changed the rules on this bucket 3 different times in 82, 84, and 88, and every single time they changed the rules, they simply said, hey, whoever has the bucket before the rule changes gets to keep it and continue to put money into it under the old rule for the rest of their lives. What do we call that kind of a clause? We call it a grandfather clause. Now, usually at this point, someone will say, hey, Dave, that sounds like the perfect bucket. This is like the alignment of the stars. Why not just put all my money into there? Well, first of all, is it ever a good idea to put all your eggs into any one basket? The answer is no. Not only that, but the IRS says if we're going to give you the benefit of an unlimited bucket of tax-free dollars, we're going to require that there be a cost of admission. We're going to require that there be a spigot attached to the side of that bucket through which flows on a monthly basis some expenses. And what do those expenses go towards? They go towards some administrative fees, but they primarily go towards the cost of term life insurance. In summary, cash value life insurance, or the L.I.R.P, can be a very strong facet of a comprehensive balanced approach to tax-free retirement planning. So, given all these admirable qualities, why does Dave Ramsey have such an axe to grind? Why do these anti-cash value life insurance posts keep popping up in my Facebook feed? Well, as you comb through all the bad analogies and misinformation, you'll see that Dave Ramsey has 2 unfounded criticisms of cash value life insurance. Let's break it down. First beef: it's too expensive. He fixates on the front-loaded expenses in the early years of the program and extrapolates those expenses out over the life of the program. This is disingenuous at best and mathematical malpractice at worst. Here's the truth. The longer you keep your L.I.R.P., the better it gets. As I explained in my video, Why Does Dave Ramsey Hate Permanent Life Insurance? You should only begin an L.I.R.P. if you're planning on keeping it until death do you part. That's 30 to 50 years for most people. If you don't think you have the stomach for that type of long-term commitment, then you shouldn't enter into the proposition. But people enter into these types of long-term contracts all the time. Ever heard of marriage? And here's the thing. Something pretty amazing happens to the average internal expenses inside your cash value life insurance policy as time wears on. If structured properly, they can drop to as little as 1% of your cash value on average per year. That compares favorably with most 401k plans and the very mutual funds that Dave Ramsey recommends. The second reason Dave Ramsey hates cash value life insurance is because he thinks the middle class is making contributions to it in lieu of their stock market investment portfolio. Once again, Dave Ramsey is out to lunch. The truth is, these types of policies will grow anywhere from 4 to 7% net of fees over time. Now, that doesn't really compare to a stock market portfolio where you might experience 8 to 10% net of fees over time, but no one is suggesting that cash value life insurance replace the stock market portion of your portfolio. If anything, it should serve as the bond portion of your portfolio. As Tom Hegna says, reach into your retirement portfolio, take out the bonds, and replace them with cash value life insurance. If you do so, you'll increase your return, lower your risk, lower the standard deviation of your overall portfolio, and experience a better outcome over time. So, in the face of all the positive evidence for cash value life insurance, why is Dave Ramsey so antagonistic? At the end of his Facebook post, his true colors really shine through. Right now, you can get a free quote from the only company I trust to treat you right and get you the best coverage. See how affordable term insurance can be for you. And there it is, folks. At the end of the day, Dave Ramsey wants you to divert premiums away from your cash value life insurance policy and into a term life insurance policy from which he directly benefits. In short, Dave Ramsey uses highly inflammatory polemics so he can line his pockets with your money. If you want to learn more about how cash value life insurance can be incorporated into a balanced, comprehensive approach to tax-free retirement, check out my best-selling books, The Power of Zero and Look Before You LIRP. And if you want to build out a plan to shield your retirement savings from the impact of higher taxes, head on over to davidmcknight.com and click on the Work with David button. I'm happy to lend a hand. If you have any questions or comments, feel free to drop them into the comment section below. I'll respond to every one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.